Ladies and gentlemen, good day and welcome to the conference call with the management of IndusInd Bank. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Suresh Ganapathy from Macquarie. Thank you, and over to you.
Yeah, thanks. Good afternoon, everyone. We welcome you to the call with the senior management of IndusInd Bank. Today we have with us Mr. Romesh Sopti, CEO of IndusInd Bank, and his entire senior management team. Of late, there have been some concerns in the market about sectors like telecom, real estate in the corporate space, and also in the retail segment, there are some concerns on commercial vehicle and microfinance book. So we actually thought it is an opportune time to get the senior management of IIB onto a call with investors. The turnout has been pretty good. Close to 90 investors are already on the call. So over to you, Mr. Sopti, for opening remarks, and then we can open up the floor for questions. Over to you, sir.
Thank you, Suresh. Thank you for proposing that we do this call. We're happy that so many of you are on the call. I think it's a good occasion for us. Mid-quarter, we haven't done calls like this in the past, but mid-quarter to actually talk about the issues which occupy the mind of the market. Suresh has highlighted some of the issues, and we will take them up one by one. The whole management team of the bank is here, especially from the areas where there is more speculation about, say, asset quality and things like that. And I will, of course, address some other issues like the succession, etc., which also occupy the minds of people, and to clarify where we actually stand. So I think just to take on the broad sort of growth numbers first, and then we'll address the issue of specific areas where there is speculation. I think if you look at the first 5 lines of the profit and loss, we are seeing continue to see very good traction, as has been visible in the last 3 quarters actually. So we have seen the interest engine starting to hum nicely, which results in a growth in our interest margin. We've grown margins by about 5 basis points every quarter. We are seeing the same trend in this quarter. That's a consequence of certainly a reduction in our cost of funding. So interest income now has started occupying central space again with us. Over the last 2 years before that, we saw that we had lost some margins, but margins have come back. So I think that part is going well. The fee part is the granulation of the fee part also continues. We have started showing for the last 3 or 4 quarters how we make our fee. So I think the speculation on how we make our fee and the sustainability of this fee, I think is addressed by the fact that there is consistency in the way the numbers shape up every quarter. So I think that is certain. There is, of course, a trend that we've also seen in the larger banks on the percentage of fee income to total income. And in the initial years, we see a much higher proportion of fee income to total income. And as the interest engine starts building up, then I think the interest occupies the center space. We are also moving on those directions, but I think in a steady state, say maybe next year or in the next whatever 18 to 24 months, we should also be moving to fee to total income in the ratio of around 34-35%, and which means interest income should be in the vicinity of about 65%. So I think that's the first 2 lines, and therefore the revenue line is pretty handsome and robust. The cost line has also been, I think, shaping up nicely. The trending is good. Cost to income ratio, therefore, has remained steady. We have said we are now coming to the end of our planning cycle 4, which is as of 31st March. We finished our 3-year period, and we had said that in this period we will reduce our cost to income ratio by 200 basis points, which we have actually done. Actually, we have exceeded that ratio. And we are now in the middle of framing our planning cycle 5, the next 3 years, where also we see good traction happening on the cost side as we sort of increase coverage of digitization in our operating systems, etc. And of course the branch network, etc. So that results in a pretty good and strong pre-provision operating profit, which as we had disclosed last quarter also, is probably the highest in the industry at around 3.8% of assets. And then of course the sixth line is where maximum focus seems to be in the market, and rightfully so, because the bottom line rises out of that. So there, I think we have, last quarter we did show, we are of course giving more and more disclosures to create sort of confidence about and more visibility on the quality of the loan book. And if you see last quarter we had shown the sub-investment grade book shrinking. The shrinkage is due to, actually it moved down from almost close to 8% to just over 3% or 3.5%. The shrinkage is due to recoveries and repayments, also due to recognition of NPAs and write-offs, and we have made provisions also, right? And I think for a small component through sales to the ARC. So that book has shrunk, definitely, and some of it has flown through provisions, undoubtedly. And I think we were also showing the SMA1 and SMA2 data, which saw a jump last quarter after being stable for 2 quarters. But that, if you sort of break it up, we will talk about it on what our expectations are and how it sort of flows through. There are a couple of accounts which are actually sovereign risk, which is public sector, which delayed payments and all, and that also affects movement by about 10-15 basis points on the SMA2 data. Apart from that, I think there were those stress groups that we always talked about, and that figure you've seen how it has shrunk from close to 2% down to 0.4%, and I think maybe quarter 4 onwards or quarter 1 onwards we don't need to disclose that because the figure is going to become insignificant. Now, I think the apprehension in the market revolves around 3 or 4 areas. I will take telecom separately at the end, but let's address 4 businesses. So basically, it's vehicle finance, both in terms of its growth prospects, the transition that is happening from BS4 to BS6, and its transitory impact, and the quality of the loan book there. The second is really the microfinance part of it, where the integration of Bharat has created a sizable portfolio in our book, which is about 10-11% of our book now, where we have seen in the first half some trends, a cyclone, I think flooding in 7 or 8 states, and things like that, which left some impact in terms of growth and also some residual provisions. But we have Mr. M.R. Rao on the call, and he will talk about what it looks like now. And vehicle finance also, we have Partha, who will talk about the status of the vehicle finance. And the third thing that has emerged recently is really about the diamond portfolio and past behavior. We've always said this portfolio is an extremely well-managed portfolio. Has not given us any pain in the past and is unlikely to give us any pain in the present or the future. But we have the head of the diamond portfolio, Biju Patnaik, here as well, so he will give you a flavor on that. And Then I'll talk about the telecom piece after that. And then we'll look at the other issues that occupy your mind, especially succession and things like that I will talk about. So let's start with the vehicle finance portfolio. So Partha, maybe you can take us through that quickly.
Am I audible, Ramesh?
Yeah, now we are. Yeah.
Okay. Vehicle for the current year, all segments of vehicles have shown degrowth in the SIAM data. Okay, passenger car degrowing close to about 16%, commercial vehicle degrowing by about 40%. Three-wheelers have also registered a degrowth and two-wheelers have also registered a degrowth. Okay, despite all that, except for commercial vehicles, we have shown growth in almost all the areas, primarily by getting market share. And the portfolio in relation to all these segments have been extremely good. The passenger cars, two-wheelers as well as three-wheelers, all segments have been equal to, if not better than the previous year. As far as commercial vehicle goes, the major we of late see certain amount of traction in commercial vehicle demand, especially from January onwards, owing to BS4 getting out on BS6 being made operational. This poses certain amount of different kind of challenges altogether for the manufacturer as well as the persons who are financing, primarily because there is certain element of risk in terms of body getting built before the cutoff date, which is 31st of March. And it is different for different states in which they have stated. Therefore, despite the fact that the underlying current has been good, the discounts more or less more than matched customer expectation. The sales for the current year, sales for the current quarter could be much lower than or equal to only the previous quarter because of the restriction whatever I had stated. Our book will also show we'll have a flat book quarter 3 vis-a-vis quarter 4, and on year growth also we used to grow at close to about more than 20% on all the years. This year will be close to about maybe 12 to 13%. That would be the overall growth, primarily pulled back by commercial vehicle. Having said so, okay, on commercial vehicle, we do see that the freight rates have remained more or less stable. The contracts have been reasonably good, and the price, I would say that the interest cost is at the lowest for them. And the fuel cost is also reducing, if not being stable. The viability of the existing operators and the market has more or less absorbed the excess capacity. The viability of the existing surviving operators have shown an increase. The portfolio, if at all, for the current quarter is expected to be steady. If not, there could be a marginal improvement in portfolio as well as, it may not drastically affect the credit cost, but you can see betterment of portfolio quality from this quarter onwards.
So I think just the explanation is that BS4 vehicles as per as per regulation now, BS4 have vehicles only those which are registered by 31st March. And the regulator has said is that they will register only those vehicles which have a full body built up. It is a statute. It is statutory that
The vehicle undergoes registration only upon body building. There are very few models which are fully built vehicle which are sold in the market. There again, the real time takes is anywhere between 10 and 15 days. Therefore, there could be, there may not be any volumes at all in March. Having said so, if the government or the court allows a spillover time only for registration, we should be able to catch up with the volumes as well. Okay.
Okay. So vehicle summary is that this quarter there is some apprehensions on registration. The underlying demand is still good. Freight rates and all have held up. And portfolio quality is stable, or maybe a marginal sort of improvement.
Okay.
That's on the vehicle side. We'll take questions later. Then on the microfinance side, MR, would you like to take us through?
Yes, sir. Good afternoon, everybody. It's particularly good for me because our business has been doing pretty well post first half. We grew by about 36% in Q3 that we declared, but Q4 seems to be far better than Q3. But I'll step back a bit after giving these numbers. The first half of this year has been extremely slow for the microfinance industry as a whole, partly because of floods and the Fani cyclone in Odisha. And the flood was in multiple states. Prior to that, last December, January itself, we felt 2 states where there was some bit of overheating, and we tightened our credit guidelines. So those 2 states were Odisha and West Bengal. So the first half you saw muted business. It disbursed about 12,000 crores. And there was also the rural distress adding to the problem, which led us to have only 12,000 crores of disbursing. But post-September, the business has improved. We disbursed about 8,232 crores, which is about 36% growth over the first 2 quarters. This quarter, I think so totally we disbursed about 20,000 crores. And this quarter, we think we'll end up about disbursing 50% of what we disbursed in the first 9 months. The customer acquisition and the demand supply gap which exists in microfinance is evident in the quarter 4 also, because our customer acquisition run rates are also significantly growing. There has been chatter about political problems and customer backlash in a couple of states, especially Assam. Assam, luckily, we have only 40 crores of exposure over a total portfolio of about 20,000 crores, which is hardly anything when you compare it to the total portfolio. There also our repayment rates are about 93% as of now. We have stopped disbursing in Assam for the last 2-3 months and reducing the portfolio. So sum and substances, I think we'll end up growing between 27 and 30% for this year as we have committed. And the fact that the demand has come back, I think we'll see significant upside in the customer acquisition and growth in the next fiscal year. There's one point I want to make. This growth that we are talking about in Q3 and Q4 has not come about because we have diluted our lending norm. We still continue to be more conservative than the market and even the Reserve Bank. So our maximum lending exposure is 1 lakh as compared to Reserve Bank's guideline of 1,25,000. We don't intend to increase those norms because we believe in a segment where there is absence of credit and financial documentation or income tax returns. It is better to be conservative, and we continue to follow the joint liability approach. The only difference that we are doing currently is there are a lot of customers who are opting for small savings through what is called recurring deposit of 50 rupees or 100 rupees per week. Those customers who are depositing regularly for 30 weeks, we are giving a 30,000 loan what they are called Vishwas loans. Vishwas is trust in English. So the portfolio, we have done about 70,000-80,000 loans, and the repayment has been impeccable. We have got 100% repayment in these loans. Overall, we have opened about 30 lakh savings accounts, and roughly 50% of those who opened the savings account and have opted for the recurring deposit scheme. So we see this as a building block for us to lend to good customers based on their saving pattern, based on their cash flow patterns in savings account next year. The last point that I wanted to make was about the initiative of Bharat Money stores that is doing extremely well. We, out of 10,000 stores that we have opened, we have done 11 lakh transactions in the first 9 months, amounting to 537 crores. 11 lakh transactions amounting to 537 crores in Q3 alone. And in 9 months, we have done 19.2 lakh transactions amounting to 847 crores. This number, quarter on quarter, is almost doubling. So Q4, you'll see far more significant numbers transacting and customers transacting through this RBSP stores. The beauty about these stores is it is just not customers who are using these stores as a transaction point, but it is the non-borrowers. So the ratio of non-borrowers to borrowers is about 70 to 30. So we think 70% of the non-borrowers are a potential customer because we have got their contact details. We know what they are transacting through our stores, and we're now trying to get the passbooks of those customers and to see whether they're capable of being lent small amounts like 30 or 40,000, which actually in a sense expands our market size much more than the microfinance market that we have been targeting so far. As I think the questions and I will be asked later. With this, I start on the forum to Mr. Sopti.
Okay, thank you, Hemant. Is there any questions on that? I think we'll take up later. And then, we've also heard some questions being raised about the diamond portfolio, the diamond jewelry portfolio, especially arising out of some of the events in Hong Kong and China. So, Viju Patnaik heads our diamond jewelry business. He's here. Viju, maybe you can give your comments.
Thank you, sir. Good afternoon. Our portfolio remains unchanged. It's very stable without any problem, and there is no SMA 1 or 2 because of the current crisis in Wuhan. Our exposure to Hong Kong is in the export bills is only around 10-11%, and we don't see any problem. Even today, we have been receiving payments from Hong Kong and China. We also gathered that the factories in Panyu post the US agreement has opened up from Monday, and the Hong Kong offices are working, though people are working from their home in many cases. So current position in the diamond and jewelry portfolio in the bank remains absolutely impeccably good, and perspective in future in case the situation aggravates in Hong Kong, China, that's only one market. Major market is US, which is more than 55%. There we see there is strong demand from the US market. Their employment rate is rather better day by day, so we don't see any problem there. And similarly from Europe and other markets, and India also continues to be a strong market in the gem and jewelry sector. So if that market and related goods get delayed because of the flare-up in the coronavirus outbreak, then at best it will impact to the extent of inventory holding period in India for similar inventory for 1-2 months. And today with LIBOR at such a low rate, I think that can be always adjusted in the profit margins my clients hold in their books. So we are not seeing any situation. If quarter end there would be no change in the portfolio quality, and going forward also we don't see that any change, and rather the slowdown in Hong Kong and China has increased the jewelry manufacturing and export from India to US. So rather our portfolio would remain neutral because of this, because the markets are moving here for manufacturing and export. So if you have any questions subsequently, I can answer. Thank you.
Yeah, so I think there's of course the inventory carrying cost that could be there. This is not a perishable commodity, so there's no issue of the thing. Of course, whenever things like this happen, the industry starts seeking concessions from the government, which is standard behavior from the industry. But the portfolio quality is holding. Growth is actually flat, and that is more by choice than anything else. But I think in the markets, I've seen that the US market is pulling very strongly, which is really where the maximum dependence of our customers. Our customers are mostly exporters, and our dependence really depends on that. And our exposure to the domestic market also is not so large. Most of these people are actually in the export markets. Since we are talking of the coronavirus, I think there's been a lot of speculation on the impact of this on businesses and things like that. So our risk has also done some work on that, possible impact. Which are the areas that we read? For instance, we've looked at the pharma side.
Solar modules.
Ramo is our CRO, is here, so he could talk about that.
Yeah. So on the coronavirus, we looked at the various aspects. One was the bulk pharma, drugs which are being imported to the pharma company. What we understand from our customers is that due to the Chinese New Year, they had stocked up for the next couple of months already. So they are not seeing any disruption in their production at this point in time. If things start getting normalized, things should fall in place. So at least till March or early April, they are okay. On the other aspects that we look at is wherever there are any solar modules to be imported. We looked at the project finance exposure. There is one project where the modules are yet to come in, but there we have a undertaking from the promoter, a very good company, a sponsor, who is given an undertaking to absorb any cost overruns. So we believe that should take care of that. There may be a delay in execution, but should be taking care of any cost overruns to the situation. Other areas are mobile phones is one area we talked about. We don't have much exposure to that sector. Auto ancillaries is something that we are looking into in detail. We are talking to whether we have very large exposures, but we are just talking to the various companies to understand. So at this point of time, on an overall basis, we haven't seen any major impact on our portfolio. There are no concentrations of companies to which we have impacted because of China's issues.
Okay. So I think these are some of the areas which have been sort of talked about. We'll talk about this thing about expectations on the trending of the provision line later, or maybe we can take that now. So maybe you both can have a talk on that.
Yeah, so I think as far as the provision line is concerned, if you look at the bank's history over the number of years, credit cost has trended in the range of 60 basis points, and there's a bit of confusion on what's the provision line, but there are other elements to the provision line, such as investment provisions and standard provisions and various other forms of provision, and therefore accelerated provisions as well. And therefore, historically, we have been in the range of 80 to 90 basis points, or sometimes 90 to 100 basis points, in terms of the total provision line. And I think looking into next year, we'll talk about this quarter as well, but looking into next year, I think that range could move up by about 20 basis points. Of course, we do expect that there will be some resolution to the telecom account, and we will talk about that. But I think the drivers for a smallish movement of 20 basis points is primarily, number one, that there's a sort of a mixed change, so the retail part is going a bit faster than the corporate part, and the credit cost on the retail part is slightly higher, so that's one driver. The second is we want to increase our provision cover, so that's the second sort of moving part. And the third is there is some leftover of provisions to be done from the fraud accounts that we had provided for. I think these are some of the elements that will drive a slightly higher credit cost into the next financial year. And when I'm talking of credit cost, now I'm talking about the total provision line, because that sort of causes a little bit of confusion, only talking about the credit cost. As far as this quarter is concerned, I think we want to take our provision covers past 60%. We have talked about that in the past. We want to take our provision cover on ILFS to well beyond 80%. So we have no more hangover from that account. And number three, there is also, as you know, last quarter we had slightly higher SMA. So some of that I think will flip, and we will have to make provisions. And that will drive higher provisions in the current quarter. But I'm quite hopeful that as this plays out, you'll see the SMA come down, and into the next year the slippages will accordingly come down as well.
Okay. Telecom, I think, is the other sort of hotspot. And there, I mean, what we are seeing so far is that there seems to be a sort of some degree of determination to ensure that the telecom sector sort of doesn't become a monopoly, and that and not neither a duopoly, but at least three players remain in the market. And some measures were taken in the past, which was essentially deferment of the spectrum charges. Then I think the movement upwards, or the repricing of services, so the ARPU movement, etc. There you probably see the impact of that only in this quarter. So they were raised last quarter. And third, I think one of the issues that sort of get missed out is that, or is not fully understood, is really what is the concession that is involved in the government stance that these payments should be made by the telcos based on their own self-assessment. Self-assessment goes sort of quarter by quarter, circle by circle, and the system. I think that was done essentially because everybody is trying to reconcile the actual number. So whether it's DOT is also trying to see whether the numbers they talked about are the right numbers. So some sort of a validation is happening, and therefore they're looking at self-assessments. And of course now they ask for data to back up the self-assessment figure that these telcos have actually arrived at. And there is some sort of questioning, for instance, on the Tata side on how did you arrive at this number. So they want some validation and some database validation of what's going to happen here. So the noises that we hear, and what we hear also from talking to the telcos, to the extent that they know which way it is going, there is some sensing that a solution to sort of make sure that they can manage this burden going forward and remain viable is being sort of worked on. What form it will take, what is the content and form of the concessions that will happen, and how it will balance out versus the Supreme Court's, directions that happened in the last hearing, that remains to be seen. Now, as far as we are concerned, our exposures have already been disclosed. We have a fund-based exposure of some 990 odd crores. We have disclosed that, and we have a non-fund based, which is the guarantee exposures in the vicinity of about 2,300, 2,400 crores. So it looks like, there's speculation that's going on what happens if these guarantees are called. Our sensing is if they call guarantees, they're virtually saying, I'm recalling your license. So it's not as simple as that I just call my guarantee and recover my money. I think when you call a guarantee, you actually go to the extent of saying that I'm actually almost cancelling your license. Because the guarantee covers continuity of some of the fees which are linked to the license. Right? So if you withdraw you encash the guarantee, it means you're actually withdrawing the license. So that's why I think it's not It's not going to happen like that. At least it's not happened like that so far. So we are waiting and watching how this situation develops. We are prepared to see at the end of the quarter or before the end of the quarter what solutions come up. We are also prepared to make some standard provisioning. The assets are standard, they are being serviced, and if you really look at the numbers, if you look at for instance Vodafone Idea, I think numbers of the loss that you see is largely on account of depreciation. So I think they are in the vicinity of a small cash loss or a cash sort of break even. And Q4 actually, because of the ARPU moving up, there could be some beneficial impact on the cash flow part of it. So I think ability to service debt is still there. The debt that exists, not the contingent debt, is not funded there, but at least the fund-based debt is being serviced properly. So the accounts are standard in our books, all the accounts. But in line with some of the policy guidances that had come from RBI in 2017, that you look at stressed sectors and through a board policy determine whether you need to proactively make provisions for standard assets. That is very much in our consideration as well. And we are prepared, basis what we see happening, to also make a proactive provisioning for this exposure well before the end of this quarter. So it's wait and watch, but we are prepared that we should take some provisions, but this will be standard asset provisioning. None of these assets are actually impaired or doubtful nature. So I think that's the telco story. Just want to touch on one or two other parts which keep getting discussed, and I think the discussion has got more focused because of the contingent liabilities that banks are carrying on account of, for instance, the telcos and the telecom sector, which is really the guarantees and LCs. So what we generally club as non-fund based exposure. We have explained in the past, but now we are sort of deconstructing that whole exposure, and you will soon see either today or tomorrow we will upload on our system the deconstruct of our non-fund based exposure. What does it actually mean? What is the implication in terms of risk weightages? What is the LC or a guarantee exposure actually translating to? What are nominal exposures versus actual exposures, right? For instance, in a foreign currency contract, nominal exposures are very large, but the potential future for the exposure is very small. We are deconstructing that. So whether it's a derivative transaction or a straightforward forward, simple forward, what does it actually mean? And you will then see for yourself, basis this presentation which we are going to load on our website for the benefit of investors, how the portfolio is actually constructed. So the speculation is around that our non-fund based exposure is twice our fund based exposure. That's not the way to actually see it. You've got to really see what is the underlying real exposure, not the nominal exposure. Because you will see that a large part of this nominal exposure arises out of foreign exchange contracts, where we have absolutely no issues. There the risk really arises if the customer refuses to pick up the contract, right? So then in that case you do your own covers in the market, and that's the impact that you may have, which could be 2% of the nominal value of the contract. So I think that will be a useful exercise for all of you to actually look at this exposure, and this sort of unnecessary sort of conjecture that happens around what we have there should be put to rest. And just as an aside, if you look at the foreign banks, if you look at their contingent exposures, which is non-fund based exposures, they vary between 7 and 12 or 13 times their fund based exposures. We have numbers here, for instance, HSBC and Standard Chartered and Bank of America and all. They vary between 7 and 13 times. So it's a focus area for them. So I think it's necessary to understand the underlying risk that is involved in these exposures, and how much of this risk actually covers project exposures, for instance. If there are guarantees covering project exposures, yes, we treat them as the 100% risk weightage. There's 100% risk. It's like a term loan. We don't in our credit assessment, we don't look at them differently. But if it is a performance guarantee, it is a completely different It depends on the performance of your customer to deliver, and which case the risk weightage falls to 20%. Right? If it's a AAA company, the risk weightage is 20% of 20%. It's 4%. I think that needs to be understood. So we have tried to do that. This presentation is ready, and we will probably upload it today, if not tomorrow. I think that's largely around. Yes, of course, the last issue is of succession, where also there has been absolutely unnecessary speculation on this whole thing. We've said it time and again. RBI's guideline on succession and the appointment of the succession require that the bank should put up the proposal at least 4 months before the due date. That means the date of taking over. We had actually done it 5 months before. So we were well in time. RBI does a very extensive due diligence. They go deep into past employments, take feedback from past employers. They go to various agencies and get feedback. They go into investments and holdings and directorships and things like that. They also go into the behavior of your savings bank account, for instance. How much cash withdrawals have happened and all that sort of things. So they look at it from an extreme diligence point of view, and that process takes time. In our scheme of things, not a single query has been raised questioning the choice. It's, I think, a procedural element that is just holding it for a longer period. I don't think there is any need or speculation on this score at all. This is going to happen sooner than later, and within 24 hours of it being conveyed to us, we are duty bound to inform the exchanges. So I don't think there should be any speculation on this thing. This is just adding a little bit fuel to the fire, and there could be vested interests working on that score. As far as we are concerned, we are absolutely on track. There's nothing that we are being worried about, and there's nothing that we've heard from RBI that should actually worry us on that score. Nothing of that. So I think this is a brief sketch of where we are. We hope that we have addressed some of the hotspots that are being talked about, and maybe we have some time for questions. Suresh?
I think, operator, we can open up the floor for any questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question, you may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles.
Okay, Mr. Sopti, before the question queue assembles, maybe I can start off on one particular aspect, which is basically, of course, we have this Vodafone exposure and couple of some accounts here and there. Having said that, if you were to look at the last 2-3 quarters, the trend of corporate slippages have been high. So, we had, say, a travel company going bad, paper company going bad. So we have a whole lot of these small accounts which are going bad. Now, for example, the slippages in the corporate segment was 1,200 crores last quarter, which is usually much higher than the usual run rate that we see, about 500 crores per quarter. So how can we get confidence that, some of these smaller accounts may not be there in the book, or rather can be managed relatively well, or in the current economic environment, this current trend could continue and further perhaps worsen from current levels?
Yeah, see, this particular, if you look at the history of the last 12 years, there we have had some sectoral issues, for the industry as a whole. So there was at one stage early post-Lehman, the commercial vehicle sector, and there was the construction industry as a sector. Then you had the infrastructure and the thermal power, the same sector. What we are seeing now is really across the board, across sectors, some sort of stress building up. And some of these accounts which were pretty strong when we booked them, slipped into a not so strong situation. Some of them slipped into the sub-investment grade book, etc. And we disclose our sub-investment grade book. You see how it moved up. By and large, the sub-investment grade book over the last 5-6 years has been in the same range. And in fact, we have seen a reduction in the sub-investment grade book in the last quarter or 2 quarters. Now, those slip into the NPAs, and as you rightly mentioned, these are sort of smaller exposures. A small paper exposure here, a coffee or a plantation exposure there. Then we had the travel company and things like that. Yes. So all these, I think, sort of converged, I would say, almost at the same time. And that's why I think we saw a sort of slight surge in our slippages. But we have not seen over 2 quarters any particular addition. So all the names that have been floating around are the names that actually exist. So we have not seen any addition to the names in that respect. And we've done an exercise now looking at 12 months beyond Q4. And all these accounts should be visible to you. Retail also, to that extent, you can see through lag delinquencies what is going to come and what's not going to come. I think there is a reasonable degree of confidence that we should get into the provisioning line, basis points of the nature which Sanjay actually mentioned. So while this year, a total provision line which includes every element, which is credit cost, standard provisioning, the impairment or whatever, MTM on the investment book, accelerated provisioning, for instance, right? That's one large portion of the provision line. The accelerated provisioning, I think, some element will go on because we don't want to stop at 61 or 62 or 63% in terms of our PCR. And it is our intention that we should take slowly the PCR up to beyond 70%, if not more. But 60 was the threshold, and therefore, in the last 2 quarters, we have hastened our, accelerated provisioning, and we will do that in Q4 as well. So that's a large chunk which has been added to our provision line this year. We trust that this will not be as chunky in the coming year, in the next 12 months. So while this year we are seeing a total provision number of but anything between 180 to 200 basis points, we would expect that we would have, going forward, given what we are saying and given what we are seeing in the stress book, which has shrunk massively over the last 2 quarters, we can see that this total provision line figure should be in that range of whatever. It could be anything between 100 and 120 basis points, which means a pretty significant reduction in that. So I don't think we have seen any more surprises. The telecom sector, of course, weighs heavily. Also, I think that the macros will continue to play a role. If there's further deterioration in the macros, then probably you will see some more of these smaller accounts coming in. As of today, we don't see them even in the SMA1 or SMA2 figures. So I think you see Q4 numbers, especially on the SMA data, I think that should validate what our thinking on this score is. And we should get into a sort of a range-bound provision line going forward.
Okay. So, another common question in the minds of investors have been your, of course, much talked about fee income. And, the common pushback that we'll end up getting is that a lot of fees get upfronted. So, while your corporate yields on your portfolio is only 9%, but a lot of it gets upfronted in the form of fees, and therefore there is kind of a complex structuring which is being done to show it as a form of fees. So, do you think there will be any issue in the sense that, some of these upfronted fees could be problematic sometime down the future, or you think these are all genuine fees and sustainable? Just a bit more clarity on this corporate fees which is getting booked.
Yeah, Suresh, I think, let me sort of, this is the reason we were at pains to break up our fee income in the last few quarters. So if you look at, it's all in the public domain. If you look at the last quarter 3, we had 51% of our fees coming from consumer banking. And then you had 17% of the fee coming from trading. Trading is not just some high frequency trading. Trading is also taking money off the hold to maturity book, which is deep in the money, including today all banks are sitting on potential mark to market gains. The corporate piece is only 32% of our fee, and 2/3 of the corporate fee is trade, remittances, foreign exchange, and from small business.
Mm-hmm.
It's only 1/3 of the corporate fee, which is investment banking or larger corporate processing fee and things like that. In some of these areas, for example, in structured finance, there is a little bit of a slowdown, and I think part of it is voluntary because we have pulled back a little bit on the group company type of structured finance. But the business will continue at a slightly lower ebb. But end of the day, it doesn't make more than a 1 or 2% difference to our growth on the fee income. And fee will still grow close to that 20% mark. In fact, when you have a portfolio which is retail, growing faster than your corporate book, there are product lines like business banking, loan against property, auto. Many of these segments have a higher fee propensity than the corporate business. The fees are more than 1%. In corporate, the fees are less than 1%. So I think there will be stability in the fee, maybe at a marginally lower level, and we will grow our fee close to 20%.
So if you look at the fee breakup, this whole structuring issue that is being sort of blown out of proportion, if you see the structured finance fee is only 2% of the total fee. Just 2% of the total fee. The relevance of this is already mentioned, and the significance of this to our total fee structure is pretty low. Of course, there is a loan processing fee which is 3% or 4% of that. So the major issue is this: trade and remittances, foreign exchange, and these account for half the fee actually of the corporate fee. And structured finance, which is being structured, and therefore you have taken it, is 2% of the fee. And we've been showing it for the last 3 quarters. So the significance of this is, I think it's been blown out of proportion. So there is steadiness there. 1 or 2% movements will be here and there. Trade and remittances, trade and FX, for instance, is a big piece for us. 8-9% of the total corporate fee. And there, of course, we are widening our scope. We are going into new geographies and new territories, and sort of penetrating the wallet of the customer on trade and remittances. So I think this piece is being sort of blown out of proportion. We give this number every quarter, but I think people refuse to see this number.
Okay, that's great. So, operator, are there any questions? It's already 3 o'clock. I think you guys have another meeting or something.
No questions in the queues as of now.
Okay, great. I think that's been pretty helpful, Mr. Sopti, for all the clarifications. And as I said, closer to 100 investors actually now have dialed on to the call, so it is really great. Yeah.
Wonderful. Thank you for getting me on.
Yeah, thank you so much. Yeah, okay, bye-bye.
We conclude the call, sir. Thank you. Ladies and gentlemen, on behalf of Macquarie Capital Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.